In this video presentation, we are going to be revisiting financial statements. In the past, we have talked about two of the four basic financial statements, the income statement and the balance sheet. In this presentation, we'll be taking a look at the components and formats of all four financial statements. We're ultimately going to see that the financial statements have to be prepared in a certain order, and I have listed them here in that order. The income statement, otherwise known as a profit and loss statement or a statement of operations, is prepared first. A company is also going to prepare either a statement of retained earnings or a statement of stockholders' equity second. Third, we have a balance sheet, which we know is also known as a statement of financial position. And finally, the fourth financial statement is known as a statement of cash flows. So what is the purpose of financial statements? We've talked about the economic activities of a business, and essentially the financial statements compile all this information about a company's economic activities and organizes it into standardized formats. Ultimately, what we're trying to do is communicate this information to users so that they can assess the company's profitability, financial position, and sources and uses of cash. Each of the financial statements has a standard format and answers a key question. The income statement answers the question, how profitable was the business during a period of time? So maybe we're looking at target for the year 2021, or we're looking at our own business's financial performance for the month of August, or we're looking at Walmart's financial performance, how much income or loss did they earn during the third quarter of 2022. So we've looked at an income statement before. Recall that the format of an income statement is revenues minus expenses equal net income. If revenues are greater than expenses, we'll have a net income. If expenses are greater than revenue, we're going to have a net loss. Revenues and expenses are listed on your income statement in order to calculate net income or loss. A retained earnings statement or a statement of stockholders' equity answers the question, how much of the company's income was reinvested in the business during a period of time? So during the year 2021, Target earns X amount of net income. They can pay out that income to the owners, the shareholders, in the form of what we call a dividend. A dividend is a distribution of the company's profits to its shareholders. Alternatively, Target could choose to reinvest those profits in the business, grow the business, which is presumably going to increase the stock price and also ultimately benefit the owners or shareholders. So the retained earnings statement, we can tell how much of the company's income earned during a period of time was reinvested in the business. So the format of a retained earnings statement is beginning retained earnings plus net income or minus a net loss minus the dividends, and that gives you your ending retained earnings balance, right? So retained earnings is the account that basically shows you how much of the company's earnings have been reinvested over time. The balance sheet answers the question, what assets did the business control and what amounts did it owe at a given date? So we know that assets, liabilities, and equity accounts are found on the balance sheet. And the format of the balance sheet is what we call the accounting equation, which is assets equal liabilities plus equity. Assets are the resources that the company controls at a given point in time. Liabilities are the amount that it owes, and equity is owner investment in the business. So liabilities and equity are two ways that businesses are financed. So another way to think about your balance sheet is resources equal sources of financing. So for the income statement and the statement of retained earnings, those two statements are prepared for a period of time. It might be a month, it might be a quarter, it might be a year. But when you prepare a balance sheet, you have to prepare it at a point in time. So if a company uses the calendar year for its accounting period, then December 31 is the last day of that period, and so we would prepare our balance sheet as of December 31. So what did we own as of December 31? What did we owe as of a specific date, December 31? Finally, we have the statement of cash flows, and by looking at this statement, we can tell how much cash was generated and how was it used during a period of time. So once again, that period of time, which we refer to as an accounting period, might be a month, it might be a quarter, it might be a year. So on your statement of cash flows, cash inflows and outflows are classified into one of three categories: operating, investing, or financing. And then once we have done the classification, we can determine the net increase or decrease in cash during the period. We'll be talking about the statement of cash flows in more detail later.